Michael Haas here with another episode of Debits and Credits with Haas and Dawe. And today we're going to talk about insurance. Insurance policies that every escrow company should have or should consider. Some are mandatory, some are discretionary, but certainly ones to consider that to help protect your business. Escrow, as you already know, is a very high liability industry. Between the escrow trust account and escrow transactions, there's possibilities for a lot of exposure to people coming after you for problems, people being unhappy with the way escrow transactions went, and so it's something to be considering about insurance. Because look, in the end of the day, here's what we always say about insurance. Insurance is betting you're going to lose, because if you knew you were never going to lose, you'd never deal with getting an insurance policy. But this is something we all have to consider in our day-to-day lives, our day-to-day operation of running a business. Now with escrow, there are some insurance policies that are mandatory and required. And whether your regulator is the Department of Insurance or the Department of Financial Protection and Innovation, surety bonds and fidelity bonds could be required. Now a surety bond is more like a guarantee, and it's something that the owners of the company are the guarantors of that surety bond. Because if there's ever a claim paid on a surety bond, the bonding company will go to the guarantors seeking reimbursement of that issue. And in the past, with regards to the independent escrow companies, the surety bond was really to protect the general creditors of the company, in that if a company had financial problems, a creditor could go and file a claim against the bond. But now, for the most part, that surety bond is protection for the DFPI in case it does a takeover company, or if other bills are unpaid, it can file a claim against the surety bond. Also, there's a required amount of the surety bond for the independent escrow companies, depending on the size of the trust account. Now, if what the department looks at is 1.5 times the monthly average of the trust account, and if it's at $250,000 up to $250,000, it's a $25,000 bond. Between $250,000 and $500,000, it's a $35,000 bond, and above $500,000 of trust account average balance, it's a $50,000 bond. Now, also, if an escrow company has a branch location, it's an additional $5,000 of surety bond coverage for every branch location, and up with no maximum, depending on how many branches that the company may have. Another mandatory coverage for all companies in California is workers' compensation insurance. California is a mandatory workers' comp state. There are some states, such as Texas, where it's optional, but in California, all employers have to cover workers' compensation insurance for its company, with the only exception being that the owners of the company can waive off coverage for themselves. Now, also, when you're operating your business and you're leasing space from a landlord, the landlord may require general liability coverage as a condition of the lease contract. And it could be not just like a business office policy, but liability. So if anybody slips and falls on the property, that there's coverage in place from yourself as the tenant. Now, there's another part for independent escrow companies called the Escrow Agents Fidelity Corporation. This was started back in 1983. Back then, there was an insurance crisis going on, where premiums for fidelity bond coverage got to be very, very expensive. And so the escrow industry unto itself came up with this plan. It's what I call a quasi-mutual insurance company, meaning that you're not so much having ownership within the company, but you contribute to its financial support. And so every member of the DFPI family, every independent licensee, has to pay a $3,000 refundable deposit to the Escrow Agents Fidelity Corporation for every location. And that $3,000 is the seed money for the Escrow Agents Fidelity Corporation. EAFC has a $5 million protection, a $5 million pot of money, so to speak, that covers the deductible under the fidelity bond coverage. And then EAFC is responsible to go out and get its own fidelity bond that covers all the escrow companies under the DFPI. It's one big blanket fidelity bond policy. So if there's ever a loss that is caused by an employee of the escrow company, but not by an owner, but by an employee of the escrow company from a type of thing of an embezzlement of some sort or shortage that is caused by an employee diverting funds, that's where the coverage comes from that fidelity bond. Now, certain escrow companies have what they call a non-EAFC coverage type of escrow. This is one where it can be a holding escrow. It could be a personal property escrow, where the escrow itself doesn't have to do with real estate. The purchase of real estate, EAFC coverage belongs to what they call bulk sales, which is sales of businesses. It also belongs to what they call fund control or joint control escrows, which are construction funding companies. It talks about refinance of deeds of trust are covered, and whether there's a sale or a transfer of deed of trust. Those are all covered by Escrow Agents Fidelity Corporation. But all the other types of escrows, we've seen transfers of stock ownership or of LLC membership ownership transfers. We've seen holding escrows, personal property escrows, surrogacy escrows. These are not covered by Escrow Agents Fidelity Corporation, and so the escrow company has to go get its own fidelity bond. Now, this also is part of the financial code and of the Code of Regulations. And in Code Section 1723 of the California Code of Regulations defines how much coverage is needed based on the size of the trust account, with a $250,000 fidelity bond being the minimum, and that can get as high as $10 million of fidelity bond coverage. And this is required for any escrow that's not covered by the EAFC regulations in the Code of Regulations and in the Financial Code. So those are the basic types of insurances that escrow companies have to deal with on a daily basis. Now, there are other policies that the escrow companies should be considering. One of them that's probably the most prevalent is errors and omissions, professional liability, commonly known as E&O. That's if someone within the escrow company makes a mistake, whether they forget to do something over the course of the escrow transaction, or they make a mistake in what they did. And this is something that you can have insurance for that. Now, again, in the 80s and 90s, the policy was very expensive with a very high deductible. In today's world, policy is a lot more affordable, and I think more and more escrow companies are looking to have E&O coverage. And some of the customers the escrow companies deal with, some of the lenders require E&O policies to be in place. And so it's almost like the coverage is about $1 for every $1,000 of coverage. So it's not terrible. And the deductibles, we recommend people have a deductible maybe of $10,000. We've had some people have a deductible about $25,000. It's a matter of trying to measure what you think your exposure is going to be. What do you think your worst loss would be to how much coverage you would need to protect with this E&O? Now, in today's world of technology, another policy that's become very common is cyber insurance, cyber liability, to try and prevent people from hacking into your system, or to prevent people within your system creating what they call the inside job of messing up the technology and opening up doors for people to come in to create scams. Now, with cyber liability insurance, you have to be careful because there are different types of cyber policies. And so you have to make sure you're going to get the one or the ones that pertain to your situation and that you're going to need to protect against someone trying to hack into your system, or perhaps if they get into your system, how they're changing passwords, how they're getting access to the escrow transaction to get buyer information or seller information so they can come in and divert funds, or whether you're getting payoff information from an outside lender to close an escrow, and yet the bad person, the scammer gets in, sees that, and changes the payoff information so it's going their bank account and not back to the lender. There's also general liability insurance. We talked a little bit about that in the first section of this podcast, where landlords may require it. But let's say you don't have a landlord, or you own the building in which you're providing space for your office, or let's say that your company owns the building, and you don't necessarily need to have a general liability policy because of protecting the slip and fall, but it's a good idea to have general liability to protect against just things that come up from day to day in operating a business And again, the premium itself is not terrible relative to the coverage and what's available to do that. There's also property insurance, where you have physical assets, computers and desks, and other items within your company, where if those get stolen from theft, that it may be part of your business policy, it may be separate. So that's another policy to think about having to protect what you think could be an expensive cost to replace what you have. And if you have multiple locations, how to come up with policies that protect all your locations, and how to time them, or how to come up with ways that would make it a more efficient policy. This is something we talk with your insurance agent about, to where they can describe different policies available, and particularly in today's world with all technology and cyber and different ways people are coming in to steal, whether it be electronically or whether physically, these are things to protect against. So that's today's story about insurance policies available for the escrow company. See you again next time.